Hey, Mark. Well, for the U.S. specifically, there are both fundamental and technical reasons why yields keep falling. Our off-the-charts highlights one fundamental reason, which is demographics. I'm going to walk you through the linkage here between falling yields and falling consumer prices and an aging population. Dr. Ed Yardeni provided this chart for us. We're going to start you off with the yield of the 10-year. Jamie, if we can pull that up, that's your white line. As prices go up, the yield falls, and this rally has pretty much been intact since the mid to late 80s. Let's overlay inflation, which is the yellow line. There you go. And it's picked up a little bit over the past year. You see a little bit of a move up, but a lot of people, Mark, still say you can't rule out deflation.
Scarlet, at some point it looked like they were moving in tandem.
Yep, there's a correlation there. Absolutely. Let's show you now the percent of the U.S. labor force that's 16 to 34 years old. That is the blue line. This line peaked in the early 1980s and has been steadily declining as the baby boomers get older and the smaller group of Generation X fails to fill the hole. Now, according to Ed Yardeni, an aging population is less prone to inflationary buying binges. They're older. They're not having kids. They're not paying for tuition. They're not paying for extracurricular activities. They're not buying homes. They're basically doing less, investing less, doing anything that contributes to economic growth. This was a snapshot of the U.S., but you could pretty much make the case for Japan or Western Europe as well.
You discussed the fundamental reason, but there is a technical reason for this as well. What is it?
Yeah, well, people keep plowing money into treasuries because where else are you going to get such high yields relative to places like Japan or Europe for pretty good safety? If you look at the WB, World Bonds screen on the Bloomberg terminal, one of my favorite functions, the U.S. 10-year yield at 1.66%, fat and juicy, in contrast with Switzerland at negative 19 basis points, or Japan at 28 basis points, or Germany at 31 basis points. If you look at it another way, Mark, countries like Brazil, Colombia, Mexico, Greece, and Portugal, New Zealand, Australia, South Korea, they have higher 10-year yields, but they're not in the same category as the U.S. They're not exactly home to the world's reserve currency. So it's a fundamental disconnect.
Is there anything that could alter this dynamic?
Well, a lot of people say that the risk here is that the U.S. economy could grow a lot faster than what investors are currently pricing in. So if GDP does pick up, then the inflation rate could easily top bond yields, which admittedly are not very high. Here in the U.S., the 10-year is at 1.66%, the 30-year at 2.23%. What that would mean if inflation does pick up is that investors would be losing money if they continue to hold on to these bonds. And St. Louis Fed President Jim Bullard basically made that case when he spoke with Mike McKee last week. He reiterated that interest rates could rise as soon as the midpoint of this year, in part because he sees longer-term inflation rising more quickly than a lot of people in the market are banking on.
Okay, but then there's always the conversation that we've been having, that dual mandate, inflation and the unemployment rate. And a lot of people think that the Fed is not paying enough attention to inflation because it's still below 2%.
Absolutely. So you go back to that original chart. Deflation is a concern that a lot of people are talking about. The risk of falling prices. You've got commodity prices tumbling, and you've got wage growth that really isn't picking up. That's a big issue, and it contributes to overall negative rates or close to zero rates around the world.